In the summer of 2025, news outlets reported a quiet but seismic shift. Canadian exports to the U.S. were in their fourth straight month of decline. Days later, Reuters confirmed Canada had inked a massive, multi-billion-dollar agricultural deal with Asia, with processed potatoes at its heart. This wasn't a coincidence. It was a calculated pivot, turning a trade war over tariffs into a shocking rerouting of one of North America's most essential food staples. How did an attempt to protect the U.S. border accidentally starve its own supply chain and turn the humble potato into a weapon of economic warfare? To understand the shock of a potato shortage, you have to understand the quiet, symbiotic relationship that for decades made it unthinkable. It was a partnership of dirt and deep fryers. The voracious American appetite for French fries, driven by fast food giants like McDonald's, created a year-round demand that U.S. farms alone couldn't always meet. Canada, particularly the fertile fields of Prince Edward Island and Alberta, became the solution. This wasn't just trade, it was a deeply integrated system. Canadian seed potatoes were planted in American fields, and Canadian processing potatoes were trucked to American factories. Companies like McCain and Cavendish built empires on this seamless cross-border flow. It was a model of continental efficiency, taken for granted by almost everyone. But the ground beneath this relationship had begun to shift. The America First doctrine of the Trump administration started to view every trade relationship through a lens of conflict. The breaking point arrived on March 4, 2025, with the announcement of a broad 25% tariff on most goods from Canada and Mexico. While not initially targeting potatoes specifically, the move poisoned the well. It signaled that no sector was safe. For an American food processor, a long-term contract with a Canadian farm suddenly became a massive financial risk. What if potatoes were next? This uncertainty was amplified by the complex rules of the USMCA, which allowed for even higher tariffs of up to 35% if certain quotas were exceeded. This political risk was already having a measurable effect. As reported by Reuters, by May 2025, Canada's overall export reliance on the U.S. had already fallen 10 percentage points in just a year. The quiet pivot had already begun. The tariff threat didn't create the desire for Canada to diversify. It simply gave them the urgent, undeniable reason to accelerate it. The weaponization of the North American supply chain reached its peak on March 4, 2025. On that day, the Trump administration activated a broad 25% tariff on most goods imported from Canada and Mexico. While major industrial sectors like auto parts and steel were the headline targets, the policy's sweeping nature meant that agricultural products were caught in the crossfire. The logic from the White House was one of brute force. By making imports more expensive, American companies would be forced to abandon their foreign suppliers and buy American, thereby reshoring jobs and industry. For the agriculture sector, the goal was to shield American farmers in states like Idaho and Washington from what the administration framed as unfair competition. The policy was further hardened by the complex rules of the USMCA trade agreement, which contained clauses that could trigger even higher tariffs, up to 35% if certain import volumes were exceeded. This created a toxic cloud of uncertainty over every cross-border transaction. For U.S. food giants who rely on a steady stream of Canadian potatoes, the very foundation of the multi-billion-dollar French fry and potato chip industry, the risk became untenable. A 25% tariff on a low-margin bulk commodity like potatoes doesn't just squeeze profits, it obliterates them. The threat of an even higher 35% tariff made long-term planning impossible. The administration's calculation was that faced with this economic reality, major buyers like McCain Foods in their U.S. operations, Lamb Weston, and even fast food giants like McDonald's would have no choice but to cancel their Canadian contracts and shift their sourcing to domestic U.S. farms. It was a strategy designed to force a painful choice on America's own corporations, believing their allegiance to the American market would outweigh their loyalty to their established Canadian suppliers. It was a fundamental misreading, not only of market economics, but also of the quiet, strategic pivot that was already well underway across the border. Washington believed it was putting Canada in a chokehold. In reality, it was handing them the justification to break free. Canada's response was not a declaration of war, but a quiet, calculated act of economic self-preservation. There was no immediate tit-for-tat tariff on American goods. Instead, Ottawa let the market dynamics created by Washington's own policy do the work. The 25% tariff made Canadian potatoes instantly too expensive for many U.S. buyers. Long-term contracts were left to expire, and new orders dried up. This wasn't a government ban. It was a market rejection, triggered by U.S. policy. The result was a staggering collapse in the trade. While official figures were still being compiled, industry reports and internal estimates, as cited in some online analyses, suggested a gut-wrenching 40% drop in potato exports to the U.S. in the second quarter of 2025. That equates to roughly 140,000 tons of potatoes that were no longer heading south, enough to supply the annual needs of over 17 million American households. But Canada did not let those potatoes rot in the fields. While the American market was closing its doors, Ottawa was aggressively kicking open new ones in Asia. As confirmed by Reuters in early July, Canada was deep in negotiations for a new free trade agreement with the ASEAN bloc. More concretely, as reported by Alberta Farm Express, they secured a massive 1.6 billion Canadian dollars deal with a consortium of Asian economies, including Japan, South Korea, and Indonesia. This deal wasn't just about selling raw potatoes, it was a strategic move up the value chain. The focus was on processed products, premium frozen French fries, specialized potato starches, and gourmet potato chips, tailored for the discerning and rapidly growing middle-class markets in Asia. It was a brilliant pivot. They took a crisis manufactured in Washington and turned it into a springboard to capture new, higher-margin markets, permanently reducing their economic dependence on their volatile southern neighbor. The message was clear. Canada was no longer content to be just America's farm team. This created a painful new reality on both sides of the border. The U.S. administration was now facing a self-inflicted supply shock. Its policy had failed to force a Canadian concession, but had succeeded in driving up food prices for American consumers and creating chaos for its food processing industry. Backing down would be a political humiliation, but pressing forward would only worsen the economic pain. For Canada, the pivot, while strategically brilliant, was not without cost. Farmers in provinces like Prince Edward Island and Alberta, faced with canceled U.S. contracts, were forced to reduce their planting acreage by an estimated 15 to 25%, creating significant local economic anxiety. They were gambling that the new Asian markets would grow fast enough to absorb their capacity. Most profoundly, the trust that had underpinned this trade for generations was broken. Even if the tariffs were lifted tomorrow, American importers would now view Canadian suppliers as a source of political risk, and Canadian producers would view the American market as dangerously unstable. The once seamless supply chain was now fractured by suspicion and doubt. For the Canadian potato farmer, the U.S. tariffs forced a painful but ultimately strategic reckoning. The loss of U.S. contracts was a direct hit to the bottom line for growers in the Maritime provinces and Alberta. Companies like McCain and Cavendish, the giants of the industry, were forced to scale back their orders for raw potatoes destined for U.S. processing plants, leading to an estimated 15 to 25% reduction in planting acreage in some regions. This created immediate economic hardship in communities where the potato is not just a crop, but a way of life. However, this short-term pain was the catalyst for a long-term gain. The $1.6 billion deal with Asia was a lifeline. It incentivized a fundamental shift in the Canadian industry, away from selling a raw commodity and towards producing higher-value processed goods. This meant more investment in Canadian processing facilities, more skilled jobs in food science and manufacturing, and higher profit margins. By focusing on the specific tastes of Asian markets, developing new fry cuts and chip flavors, the Canadian industry was embedding itself in new, fast-growing global supply chains. The crisis forced them to innovate, diversify, and ultimately build a more resilient and profitable industry, one that would be forever less susceptible to the political pressures from a single dominant customer. In the United States, the consequences were felt directly at the dinner table and in the drive-thru. With roughly 140,000 tons of Canadian potatoes suddenly gone from the market, American restaurants and food processors scrambled to find replacements. They turned to domestic suppliers in Idaho and Washington, but the sudden surge in demand for a limited supply caused prices to spike. Restaurant owners in border states like North Dakota and Minnesota reported paying up to 25% more for domestic potatoes that were often of a different size and quality, forcing them to adjust recipes and recalibrate frying equipment. This cost was inevitably passed on to consumers. As documented by publications like Food and Wine, the price for a 50-pound bag of processed potatoes, a restaurant staple, shot up from around $22 to nearly $30. Fast food giants like McDonald's and Wendy's faced a crisis: either absorb the higher cost and hurt their margins, or raise the price of their iconic French fries and risk alienating customers. The overall impact contributed to a 2 to 3% increase in food price inflation in the first half of 2025. The policy designed to protect American farmers had resulted in American families paying more for a lower quality meal, a stark and immediate demonstration of the hidden costs of a trade war. And so, North America stands at a crossroads it never anticipated. A trade war, intended to bring an industry home, has instead outsourced a nation's food supply to new markets. The United States is left with higher prices, angry consumers, and a fractured supply chain. Canada, forced to adapt, has forged new, lucrative partnerships, fundamentally altering its trade destiny and reducing its reliance on its southern neighbor. The invisible artery that connected the fields of Prince Edward Island to the deep fryers of America has been severed, perhaps permanently.